Imagine this. Millions of homeowners waking up to discover that the investment they once thought was rock solid is bleeding out in real time, faster than the collapse of 2008 ever dared. Paychecks can't keep up. Mortgage rates are strangling potential buyers, while insurance premiums blast off into the stratosphere. Families are being buried alive under monthly payments of $4,000 or more. Investors, once confident, are now unloading properties by the dozen. And foreclosure signs? They're spreading across neighborhoods like wildfire. This isn't some gentle, soft landing. What we're watching is a financial guillotine, coming down hard on America's most dangerously inflated markets. From hurricane-battered Florida to Silicon Valley's shrinking tech empire, the cracks in the system aren't just showing, they're erupting. Welcome to the countdown of 10 U.S. cities where the housing crash could hit harder than 2008. Number 10. Riverside, California. Riverside is shaping up to be ground zero for a looming housing disaster. During the pandemic surge, median home prices blasted past $585,000, even though the typical household income here sits at just $82,000. That gap has forced buyers into debt levels even more severe than those leading up to 2008. At today's 7% mortgage rates, the monthly payment on a median-priced home runs close to $3,800. That eats up over 55% of the average family's gross income, far above any reasonable affordability line. Back in 2008, Riverside's housing market crumbled under the weight of risky exotic loans. Today, the villains are different, crushing interest rates, inflated valuations, and everyday living costs that keep climbing. And the market is drowning in inventory. Active listings have surged nearly 65% year over year, while builders in Menifee and Moreno Valley keep flooding the market with new subdivisions that most families simply can't afford. Already, 30% of listings have been hit with price cuts, some slashing $50,000 to $100,000 just to tempt hesitant buyers. Investors, once eager to scoop up single-family rentals, are now fleeing. With rents flattening at around $2,400 a month, they can't cover the costs of mortgages, property taxes, and soaring insurance premiums. That leaves rows of investor-owned homes sitting unsold, each price cut dragging neighborhood comps even lower. The cracks are visible everywhere. Foreclosure filings in Riverside County have jumped 38% year over year. And as adjustable-rate mortgages reset higher, the pain is only beginning. The equity that looked untouchable back in 2021 is vanishing. Buyers who put little money down are staring straight at negative equity. Add in California's punishing costs for gas, utilities, and insurance, and households here are suffocating under the weight. Riverside's collapse in 2008 was devastating. But this time, the toxic mix of bloated monthly payments, runaway supply, and investors dumping properties could drive a correction that doesn't just rival the last crash. It could erase it from memory. Number 9. Atlanta, Georgia. Atlanta was once the shining example of affordable Southern living. But those days are gone. And what's on the horizon looks even darker than the 2008 collapse. Today, the median home price across the metro sits near $420,000, while the typical household brings in only about $77,000 a year. At current 7% mortgage rates, that translates to a monthly payment of roughly $2,900. For many families, that's nearly 45% of their income, well above the line of affordability. In 2008, Atlanta's housing crash was fueled by reckless lending. This time, the problem is different, an extreme mismatch between wages and bloated home values, compounded by a tidal wave of investor speculation. In some suburbs, investors now control close to 30% of single-family homes, leaving the market dangerously fragile. And when rents stall out around $2,100 a month, while insurance premiums climb past $2,500 a year, corporate landlords start to panic. They dump properties, flooding the market with oversupply and triggering cascading price cuts. Already, More than 28% of listings are chopping $40,000 to $60,000 off their asking prices just to lure buyers who can no longer qualify for oversized mortgages. The warning signs are everywhere. Active listings are up 55% compared to last year, a red flag that mirrors the months just before the last crash. Foreclosure activity is creeping back too, with filings in Fulton and DeKalb counties up nearly 30% year over year. Adjustable rate loans resetting higher are squeezing working-class homeowners the hardest. Once negative equity spreads, a fire sale becomes inevitable. And Atlanta's job market isn't offering much relief. Growth in logistics and construction, two of the city's major pillars, is slowing, undermining the booming metro narrative. Back in 2008, prices tumbled in double digits, but recovery came fairly quickly. This time feels different. With investors overleveraged, incomes flat, and the cost of everything from groceries to utilities rising, the foundation looks weaker than ever. If even a fraction of those investor-owned homes hit the market over the next year, Atlanta's housing crash could be sharper, faster, and far more punishing than the last one. Number 8. Phoenix, Arizona. Phoenix was one of the ground zeros of the 2008 housing collapse, and today, the stage is being set for an even harsher sequel. Right now, the median home price hovers near $470,000, while local household income averages only about $78,000. That mismatch forces families into staggering debt just to buy modest tract homes. At today's 7% mortgage rates, a typical monthly payment balloons to around $3,200, nearly half of the average family's income. That's a recipe for widespread defaults. In 2008, the crash was fueled by speculators flipping houses like lottery tickets. Today, the threats are more complex. Inflated valuations, overzealous construction, and climate-driven insurance spikes. Builders have blanketed Maricopa County with new developments, and now unsold inventory is stacking up. Active listings have surged over 70% in the past year, and nearly 35% of sellers are chopping prices, some slashing more than $100,000 to lure wary buyers. Investors who once swarmed Phoenix are now bolting. With rents stalling at about $2,000 a month, they can't cover mortgages, rising taxes, and insurance bills that often top $3,500 a year in heat-prone zones. Vacancy rates are creeping upward, especially in the sprawling outer suburbs, where half-empty subdivisions echo with the same ghost town vibes seen in 2009. Foreclosures are climbing too, up 40% year over year, with defaults hitting hardest among buyers who jumped in at peak 2021 prices. Many of those homeowners are already sinking into negative equity, trapped in properties they can't sell without taking six-figure losses. And Phoenix has extra headwinds: water shortages, soaring utility bills, and insurers pulling out of high-risk flood and fire zones are making the true cost of ownership spiral out of control. Back in 2008, Phoenix lost nearly half its home value before finally stabilizing. But this time, monthly debt service is nearly double what it was then. That means the next correction may not just mirror 2008. It could cut even deeper, leaving thousands stranded in homes worth far less than the crushing loans tied to them. Number 7. Detroit, Michigan. Detroit's housing market has lived through collapse before, but what's forming now threatens to carve scars even deeper than the Great Recession. At first glance, the numbers look cheap. The median home price sits around $200,000. But the local median household income is only about $39,000. That gap means even affordable homes are out of reach. With mortgage rates hovering near 7%, a standard loan now demands close to $1,400 a month. That eats up more than 40% of a family's income before you even factor in taxes, insurance, or utilities. Back in 2008, Detroit's crash was driven by the implosion of subprime lending. This time, the danger comes from a fragile economy colliding with inflated values propped up by speculative buying. Investor ownership has exploded here. In some neighborhoods, nearly 40% of homes were scooped up by outside landlords. But with rents stagnating around $1,100 a month, those investors are heading for the exits, dumping properties in bulk. Already, 33% of listings show price cuts, some slashed by $30,000 to $50,000 just to attract reluctant buyers. Inventory has swelled 60% year over year, a clear sign that demand is drying up just as supply floods in. And the local economy is another ticking time bomb. Layoffs in the auto industry ripple across the region, and when those paychecks disappear, so do mortgage payments. Foreclosures in Wayne County are up nearly 35% compared to last year. Many who bought at post-pandemic peaks now face negative equity as neighborhood comps sink lower and lower. Even Detroit's taxes stack the deck against homeowners. Property tax rates often exceed 2.5% of assessed value, turning what looks like a bargain into a long-term burden. In 2008, Detroit was one of the hardest-hit cities in America. Entire blocks were left abandoned. But today, with inflated investor portfolios, stagnant wages, and a fragile economic foundation, the next downturn could unfold faster and cut deeper. Instead of a slow bleed, Detroit risks a brutal freefall, where affordability vanishes, equity evaporates, and neighborhoods buckle under a wave of distressed sales that could eclipse the last crash. Number 6. Tampa, Florida. Tampa's housing market has become a powder keg, and the numbers are flashing red. Median home prices have exploded to nearly $430,000, while the typical household income lingers around $70,000. At today's 7% mortgage rates, the monthly bill on that median home hovers near $2,950. That's more than half of a family's gross income, and completely unsustainable. Back in 2008, Tampa's crash was fueled by reckless loans. This time, the threats come from a toxic mix of inflated prices, soaring insurance premiums, and relentless hurricane risk that makes ownership feel impossible. Florida's insurance crisis is hitting Tampa square in the chest. Annual premiums in the Bay Area have blasted past $6,000, and for some waterfront properties, coverage isn't available at all. Sellers who bought at peak 2021 prices are already panicking. Roughly 30% of active listings have seen price cuts, with reductions as steep as $70,000. Inventory has ballooned 60% year over year, while builders in Pasco and Hillsborough counties keep adding new subdivisions, flooding a market that's already oversupplied. Investors aren't immune either. With rents flattening around $2,100 a month, many are now cash flow negative. Foreclosure filings are rising fast, up 42% in the past year, as adjustable-rate mortgages reset higher and insurance renewals shock households with crushing bills. Negative equity is spreading among buyers who put little down, and with property taxes tied to those inflated values, carrying costs are suffocating families. The parallels to 2008 are striking, but this time, the climate-driven insurance chaos adds another layer of risk that could make the fallout even worse. Tampa's growth story, sunshine, retirees, new jobs, can't hide the reality. Too many overpriced homes, too few buyers, and ownership costs spiraling out of reach. This is a city primed for a brutal correction. Number 5. Oakland, California. Oakland's housing market has been stretched to its breaking point, and the collapse brewing here could make 2008 look mild by comparison. Median home prices remain staggering, hovering around $875,000, while the median household income is only about $92,000. That's nearly a 10-to-1 ratio, financial suicide by any standard. At today's 7% mortgage rates, the payment on a median home lands near $5,700 a month, swallowing almost 75% of the average family's income. That's not a sustainable market. It's a slow-motion implosion. And the cracks are already showing. Active listings are up 50% year over year, with nearly 35% of sellers slashing asking prices by $100,000 to $150,000 just to stay in the game. Investor interest is vanishing as rental yields collapse. Average rents sit around $3,000, nowhere near enough to cover mortgage payments, insurance costs, and California's notoriously high property taxes. Add in rising crime rates and a steady exodus of families relocating to more affordable states like Texas and Nevada, and demand dries up even further. Meanwhile, foreclosure filings in Alameda County are already up 28% this year, proof that households stretched thin during the pandemic are beginning to buckle. The job market isn't helping either. Tech layoffs across the Bay Area are eroding buyer confidence as shrinking paychecks collide with towering housing costs. Unlike 2008, when toxic mortgages detonated the market, today's crisis is rooted in something simpler and far more destructive: affordability collapse. The math just doesn't work for buyers, landlords, or even longtime owners struggling with higher taxes and maintenance. Oakland's position is especially precarious. If the Bay Area downturn accelerates, Oakland will be hit the hardest. It lacks the prestige buffer of San Francisco, but still carries nearly the same bloated price tags. The last crash gutted equity. This one could hollow out the market entirely. Number 4. Cape Coral, Florida. Back in 2008, Cape Coral was ground zero for America's housing collapse, losing nearly 60% of its home value. But what's happening now may be even worse. Today, the median home price has climbed to roughly $415,000, while the typical household earns only about $68,000. At current 7% mortgage rates, that median home demands a monthly payment of around $2,850, over half of a family's income. And that's before factoring in Florida's crushing insurance premiums. Many homeowners now shell out more than $9,000 a year for coverage, if they can even find a policy. Inventory has exploded, surging 85% year over year. Nearly 40% of active listings have already seen price cuts, with some slashed by $100,000 to $120,000 just to draw interest. Rents, once advertised as strong, have stalled at about $2,000 per month, leaving investors bleeding cash. Builders added thousands of new homes during the pandemic boom, and those subdivisions now sit half empty, echoing the eerie silence of the last crash. The cracks are widening. Foreclosures in Lee County jumped 45% in the past year, and homeowners who bought at peak valuations are already underwater. Negative equity is spreading like wildfire, trapping families who can't sell without losing tens of thousands. Layer on the hurricane threat. Hurricane Ian alone caused $113 billion in damages, and it's no wonder buyers are fleeing in droves. Property taxes tied to inflated valuations only worsen the burden, forcing fire sales that speed up the spiral. In 2008, Cape Coral became the poster child of America's housing collapse. But today, with even higher insurance premiums, more speculative building, and households more financially fragile, the correction ahead could strip equity away even faster than last time. Cape Coral isn't just vulnerable, it's already in freefall, and the bottom may be far lower than anyone expects. Number 3. Las Vegas, Nevada. Las Vegas has always been the ultimate boom and bust city, and all the signals now point toward another brutal collapse, one that could rival, or even surpass, what happened in 2008. The median home price here still hovers around $430,000, while the typical household income is just $72,000. At today's 7% mortgage rates, that means monthly payments topping $2,950, more than half of a family's gross income. That's not sustainable. Back in 2008, Vegas homes lost nearly half their value. This time, the affordability crunch is even more severe. Oversupply, investor retreat, and fragile demand are all converging into something nastier. Inventory has exploded. Active listings are up nearly 70% year over year. More than 35% of sellers have already cut prices, in some cases slashing $80,000 to $120,000 just to get noticed. Investor ownership remains heavy, especially in condos and single-family rentals. But with rent stuck around $1,900 a month, the math doesn't work. Rising HOA fees, insurance premiums over $3,000 a year, and steep property taxes are choking profits. Institutional investors are now unloading properties en masse. That flood of inventory drags comps lower and accelerates the downward spiral. Foreclosures in Clark County are climbing fast, up 40% year over year, hitting hardest among buyers who stretched themselves thin during the 2021 frenzy. Many are already underwater, unable to refinance, and staring at losses they simply can't absorb. And unlike 2008, today's risks go beyond housing itself. The local economy is wobbling. Tourism, the lifeblood of Vegas, is weakening under the weight of inflation, higher travel costs, and fewer international visitors. When casino jobs disappear, so does housing demand. Las Vegas has always been a high-stakes gamble. In 2008, the house wiped out half the market. But today, with higher borrowing costs, fragile employment, and speculative inventory sitting idle, this downturn could be steeper, sharper, and even more devastating. The Strip may still glow with neon, but the neighborhoods behind it are already dimming fast. Number 2. San Jose, California. San Jose sits at the peak of America's housing bubble, and if it bursts, the fall could be catastrophic. The median home price here is an astronomical $1.4 million, while the typical household income is just $136,000. That's a staggering 10 to 1 price-to-income ratio, among the highest in the nation. At today's 7% mortgage rates, the monthly payment on that median home soars above $9,200. That's nearly 82% of the average family's income, an impossible number by every standard. The cracks are widening. Active listings are up 45% year over year, and nearly 30% of homes have already cut prices, often by $200,000 or more. Tech layoffs sweeping across Silicon Valley are slashing buyer demand and forcing some owners to sell in a hurry. The rental market isn't offering any safety net. Average rents hover near $3,200, nowhere close to covering mortgages, property taxes, and maintenance on million-dollar homes. That reality is chasing investors out of the market, leaving a glut of overpriced properties lingering unsold. Foreclosures in Santa Clara County remain relatively low but are rising, up 22% from last year. And as negative equity begins to spread among those who bought at pandemic peaks, more defaults are inevitable. The difference from 2008 is striking. Back then, toxic loans set off the collapse. Today, it's pure affordability failure. Even high-earning tech families can't carry today's payments, not with shrinking equity portfolios and stock options losing value. San Jose has always been an extreme market, but now its foundation is crumbling. If layoffs continue and buyers retreat further, the domino effect could move swiftly. With one of the weakest affordability ratios in the country, San Jose isn't just headed for a correction. It's bracing for a plunge that could define the next housing crash. Number 1. Austin, Texas. Austin was the darling of the pandemic housing boom, a symbol of limitless growth and opportunity. But that boom has curdled into one of the ugliest busts in the nation. Median home prices skyrocketed to nearly $600,000, while household incomes average only about $86,000. At today's 7% mortgage rates, the monthly payment on that median home hovers near $4,100, devouring 57% of the typical family's income. Back in 2008, Austin escaped the devastation that crushed so many other cities. But this time, it's ground zero. Inventory has exploded. Active listings are up an astonishing 90% year over year, and nearly 40% of sellers have already cut prices, reductions averaging between $75,000 and $150,000. Entire subdivisions around Pflugerville, Leander, and Georgetown are drowning in unsold homes. Builders are desperate, tossing out massive incentives, tens of thousands in discounts, rate buydowns, even free upgrades, just to move product. Investors who swarmed in during Austin's tech-fueled rise are now retreating. With rents flattening at around $2,400 a month, they can't cover soaring mortgages, insurance, and some of the highest property taxes in the country. Foreclosures in Travis County are up 48% year over year, and the pressure is mounting. Families who bought at the feverish peak of 2021, often with minimal down payments, are already underwater, trapped in homes worth less than their debt. Job cuts in the tech sector only worsen the storm, draining the buyer pool at the very moment supply is overwhelming the market. And property taxes, frequently topping 2% of assessed value, make the monthly burden unbearable for many households. Austin's rise and fall is dramatic. From being hailed as the hottest housing market in America to becoming one of its most fragile, the reversal is staggering. In 2008, Austin stood tall while others crumbled. But in 2025, the roles may reverse. The city that once symbolized boundless opportunity could soon stand as the cautionary tale, the epicenter of a housing crash that may prove not just equal to 2008, but far worse.